Okay, brief history of crowdfunding. Thank you, Matthew, for that. As you will see, this is a very simple diagrammatic expression of how it all began. You'll see, as Matthew also said, the World Bank reporting to us saying that we're one of the first, or actually we are the first equity-based crowdfunder globally. Raised almost, says there, US 140 million for over 176 companies, no instances of fraud. Just want to take you through, my discussion today is about the evolution of crowdfunding, where we think it's going as an industry and how everyone in this room can benefit of that, how we can all grow together, and where we think this industry as a whole can actually grow to really change the dynamic in early stage companies' growth and financing across Australia and across Southeast Asia particularly. So 1997, the first instance of crowdfunding to our knowledge was a British rock band called Marilyn. They sent out to, I think it was about 13,000 members. They needed to go to the US to tour. They didn't have the money. They were a rock band, and they got $60,000, and that paid for their first trip, their first tour. They went to the States. That then moved on, as you'll see, that we had a crowdfunding platform for music. So it started, funnily enough, in the arts space, moved across to peer-to-peer lending in 2005, and then, as Matthew said, in 2007, ASSOB was created, originally under Section 708 of the Corporations Act, and we've successfully raised through that period today to almost $150 million through retail and wholesale clients. Now, this is where we think we're going at the moment. So this is a combination of a couple of different articles and our own thoughts on where we believe the market's going and where we believe as a group of companies in this room where we think we are going to be getting towards. You'll see there that my chairman always says that this is him, stage one. It's the rewards-based crowdfunding. This is the Marilyn type process. This is, you get your name on a t-shirt, you get your name in a band flyer, something along those lines. This typically started, as we saw in that previous slide, back in the late 90s. Stage two is your online investing, and this is really where ASSOB started, and it was characterised towards smaller parcel sizes. So we're talking about somewhere between $150,000 and say $250,000 worth of actual capital raised. It was purely digital. Across the world, it was more wholesale, high net worth investors, whereas in Australia, funnily enough, through companies such as ourselves, it was a mixture between wholesale and retail investors. Stage three is really where most of the world is now. Australia will be there when everyone starts getting their AFSLs, in our view. It's equity. It's a full-blown equity-based crowdfunding. It is where you have a licensed market, you're regulated, and that people can invest. Your typical mum and dad investor can actually invest across and into your platform. Where we see the market now changing is now that the regulation is in play, and now, and we've heard it across a couple of different platforms, be it rewards or other equity platforms, is that there is now a duty of care for a platform to work with their issuer to make sure the investor, who is ultimately the main player in this, because if you don't have investors, you can't get them funded, you can't get an entity funded, are actually rewarded, and that means a financial return. So if you take it down that pathway, what you're actually saying is crowdfunding, or stage 4 of the evolution of crowdsourced equity funding, becomes an ecosystem. And by an ecosystem, we talk about, we've got six key points there. So highly scientific, qualified methodology for actually screening a venture coming through. Why is one company going to be successful and one company not? I don't know in this room how many of my companies in this market sit there, and we see daily a whole range of different businesses that come through. Why did this one succeed and why does this one not succeed? So to put some science, to put some methodology, put some rigour behind it, how do we actually provide a non-biased, repeatable screening methodology that assesses whether or not a business coming through your platform is more likely to succeed, and therefore your investor is more likely to get a return. Okay, so that's our first one in a digital ecosystem. Number two, better than average returns. Quite simply, we are unfortunately, or very fortunately, a returns-based business. An ecosystem provides you potentially with the ability, or more likely with the ability, to actually deliver better returns to the investor. Recurring revenue streams. It's an interesting concept. A platform is here. If you flip it on its head and say a platform is here to help early stage companies and it's going to disintermediate a whole range of different current capital raising services, then you're looking at developing recurring revenue streams as you are going through that process, because ultimately what you are doing is you're working with the companies to make sure that they are more successful, and therefore you're getting a fee generation out of it. We actually just had this discussion before. Compliance. Compliance, some people don't like it. We at ASSOB do like it. We think it's a good thing. We think that people need to make sure that they are behaving in accordance with the way that they should in relation to their shareholders. We've almost gone down the path where we say it should be ASX light. This is about getting companies early, about training them up, making sure that they're doing what they said they would do and being compliant to their investors. Pretty simple. If you're going to take $2 million from people, you should probably actually make sure you hold your annual general meeting. Audit accounts, those sorts of things. And so then what we are seeing in stage 4 then, that is actually the disintermediation of typical traditional capital raising platforms. Some would say that that would be a VC job. And so there is the opportunity there by providing scale and scope across a whole lot of different industry sectors and vectors to actually provide a huge range of services. Stage 5 is where we as a platform are hoping to be early next year. And stage 5 is really about how you're starting to utilise different elements of financing structures, and by that I mean it might be a fund, it might be having a broader range of investing opportunities on your platform, and then actually providing a one-stop shop for investors to come along and fulfil their risk requirement or their risk premium needs by utilising your platform. By that I mean you can invest in a seed company, you can invest in a Series A, B and C unlisted stocks, and potentially stocks that are just about to transition into IPO. There's also the opportunity here that you can start to provide secondary liquidity. Now, we heard before from Domicom saying that liquidity is essential, and there is no doubt that one of the real challenges equity crowdfunding faces is that ability to provide a secondary liquid market. And that can happen through a couple of really good technological inventions such as blockchain, as I'm sure everyone here is sort of grappling with at the moment. And that's really where we move on to stage 6 of this crowdfunding market. And that is essentially interactive, global equities being able to be traded through a verifiable source across borders, across jurisdictions. So it's really interesting. As we all are in this room, we're talking with a whole lot of people across the globe, and the capacity and the desire for investors now to lift their eyes up and actually start to either invest outside of Australia or have investors from outside of Australia come in and invest into Australian unlisted securities is starting to grow. And so this is where you start to look at elements such as blockchain that can start to provide that verifiable source of truth. So this is our view on how equity-based crowdsourced funding or crowdsourced equity funding will transition over the next couple of years. Now, we talk about, and I apologise, this is one of the slides that some of the people who attended FIDS might have seen before. I talked back in stage 5 about the fact that CSEF has the opportunity to be disruptive. And you sort of sit there and say, okay, what does that really mean? And really what it means is, for the first time, the advent of legislation, and secondly, the advent of the communication metrics that we all use, enables what were traditional elements within a capital raising infrastructure or ecosystem to be broken down. So as you'll see here, as along the gestation pathway of a typical company, or evolution pathway of a typical company, you will see here that there are different disruptive capabilities now by crowdsourced equity funding. You'll see that they now really are going from all the way from prototyping all the way up to IPO and acquisition, or pre-IPO acquisition. Sorry, actually, I'll go back. There's one other point that's actually really interesting about this slide, is that by 2020 in the States, it's forecasted that equity-based crowdfunding or crowdsourced equity funding will be a larger source of funding than VCs. Now, everyone knows how big the VC market is in America. It's already bigger than angel funding in the States, and it's forecasted in the States to actually be bigger by 2020. That's a fundamental shift in the dynamics of the way capital is raised in that market. That's opening it up to a huge number of more investors who traditionally may not have had the opportunity, which then goes back to the previous point that says inherently in that is the ability as an industry that we are all here achieving and developing to make sure that we do what we can to legitimise and protect the platforms to bring returns to investors. So I apologise, I wasn't here earlier today. I flew in this morning, and I understand there was someone else who gave some numbers around the market, so my numbers are a little bit different. We have internally and externally worked on these numbers. These are the world forecasted market size numbers, and it's sitting there and saying by 2020 it should be about $113 billion in terms of total size. This is our estimate, so please just take that as it is. This is the research work that we have done based on a whole lot of different sources and combined it together. So we're forecasting that by 2020 the global market should be growing to $113.1 billion. That's a 26.87% year-on-year constant annualised growth rate for 5 years. So a CAGR of 5 years. Not all that significant. What does that mean for Australia? We've essentially applied the growth rate in Australia to those numbers, which says, and I understand there was someone earlier today, and I apologise, that said that it's going to be about $200 million. We're actually forecasting that it'll be substantially larger than that, being $1.5 billion by 2021. Now that's a fair market. That's the way I look at this, is that is a big enough market for all of us in this room to operate in and participate in and grow. And it's such an exciting opportunity for us all to actually sit there and say, right, how do we deliver the best services, the best outcomes, the best opportunity to the Australian investor and the Australian early stage capital raising companies? What's interesting about this, if you actually start to apply some of the growth rates from deregulated markets globally, this can get as high as $6.1 billion. So there is a fundamental movement of capital that we are forecasting in this market. We talked before about screening companies. We internally have a process that I just want to quickly take you through as an example of part of this ecosystem. This is one element of our ecosystem. This is our ability to look at a business model and try and, where possible, bring the most effective business models to the platform. And this is talking about business models. It's not talking about financials or legals. That's done as well as part of the process. So we have, as part of our platform, instigated a business called Amenka, stands for Improving Entrepreneurial Capacity, and essentially is a piece of software which is business evaluation calculus. It's based on 480 business cases that were assessed. A couple of PhDs have been written on it, and they assess the best 15 characteristics that you'll see up here under the 5 key product headings, and then you get some probability ratings that are based out of that. It's a little bit more complicated than that. You go to a couple of day course, you have a whole lot of pitch sessions with the consultant afterwards, but you start to get the drift, that this is part of being able to provide a repeatable, scalable, non-biased screening methodology to help provide that movement into stage 4 and stage 5 along the evolutionary pathway that we talked about before. So this is some of the work that we're doing, and this is some of the work that I know some of our competitors are doing as well, and other people in this room. So listen, I think it's what we're trying to show here is the ability for this industry to really become a source of high quality, highly profitable ventures for investors. That's essentially me today. I wanted to keep it short and sharp. We all need to go for a drink, and that clock is saying 20 to 6, even though it's wrong. Yeah, if you have any questions, please let me know.